How is it that the largest companies in America pay almost no income tax? And in many cases, like in the year 2020, 55 of the largest corporations in America paid no income tax. It's actually very legal. Let's talk about how this happened and how it's set up. All right, so let's talk about stock buybacks. When a corporation makes money, i.e. profit, they are incentivized to disperse those profits back to their investors. And they can do this either by way of dividends, which used to be the most popular way of dispersing these profits, or more popular recently, they can do what are called stock buybacks. What this does is it basically takes the profit that the company made for that year and it buys their own stock, which will then take the supply of that stock up off the market. And of course, the old natural supply and demand curve says that when the supply is smaller, you will see a higher price, right? So the investors that hold stock, the shareholders that hold that stock, now see a higher price per share that they own and can in turn sell or use that higher price to obviously enjoy as profit for themselves. The reason why corporations do this is because a dividend is not tax deductible to the corporation, as well as fully taxable to the recipient. A stock buyback is only going to be taxed on the gain. It's only capital gains tax that come into play here. So however much the shareholder bought that stock for, minus the price they sell it for after the gain is seen after the buyback occurs. So you're actually seeing a much smaller taxable event. And this does depend on when the shareholder bought the stock, right? And how much they paid for it. But as a general rule of thumb, there are much lower taxes on dispersing profits by way of buybacks as opposed to dispersing profits by way of dividends. Next, avoiding corporate tax rates. America long had what was considered a high tax rate. It was about 37% at the turn of the millennium, and it was actually lowered by Donald Trump to about 21%. The average corporation, although the corporate tax was 21, after a lot of the credits and a lot of the different ways that you can claim expenses, like we're going to talk about later, actually made the real taxable burden to be about 11%. Even that is too high for many corporations, and what they'll do is they'll move offshore or to lower developed countries that have much lower corporate taxes or none at all. Bermuda's one, right? No tax rate at all. And you can still operate in America to sell your goods, but you will set your factories up, your headquarters up in these foreign countries, which will serve as the base for where you actually will get taxed if you get taxed at all. And that's why a lot of these corporations get out of paying taxes in the U.S., although they sell the majority of their goods within U.S. markets. There are those that say that this new corporate minimum tax of 15% is going to do the opposite. It actually dissuade corporations from headquartering and establishing factories here in America, and will push them offshore into these lower developed countries, and in that way actually reducing the actual tax revenue that we actually are able to receive. Some would say that actually lowering the corporate tax rate to make it more competitive with the lower developed countries that they want to move to would encourage them to bring that back home to the actual market that they intend to sell in, and therefore allowing the U.S. to capture more of the tax revenue, even if it is a lesser amount than what was originally intended. Less is usually better than nothing. All right, CEO stock options. So this is a way of corporations compensating not just CEOs but executives in general with the option to purchase at some point in time, usually within a decade, the option to purchase that company's stock at a given price or at a given amount. So for example, you have a CEO who you would prefer to reward with stock options rather than reward with an actual increase in salary. And the reason why you would want to do this is because let's say the CEO has a promise of $1 million purchase of stocks within the next 10 years. And at the moment, let's say the stock of that corporation is about $10 a share. So at the moment, the CEO could exercise that and receive $10 million worth of stock, right? At the exact time that option to buy, that stock option is given, the corporation can then write that off their books as a expense, right? So a $10 million expense for that year. The problem here and the advantage here is that most CEOs understand, anybody who runs a corporation understands that in the long run, on average, corporations tend to have their share prices increase over time. So what is the most likely scenario here is that the CEO or the executive with the stock options would wait until that share price increases, so that instead of that $1 million buying him $10 million worth of stock, let's say the stock price goes 10 years later to $25, now that same $1 million can buy him $25 million worth of stock. And he can go ahead and sell that on the open market if he'd like to. He'd still receive a capital gains tax on it. And he would receive a income tax on the original 10 million, right? But he actually, he's actually going to net 15 million more than what he would had he just originally purchased and exercised his option. The corporation issuing it, when the actual options get satisfied, the corporation issuing it can then say that the expense for that actual transaction was 25 million for tax reasons. So originally they told investors and they told shareholders through on their books as they recorded that this was only a $10 million compensation or a $10 million expense to the corporation for that year. And then later they can report that same transaction as a $25 million expense, therefore allowing them to enjoy that much more of a deduction on their taxes. We've got depreciation. So this is effectively the idea that the fixed assets that the corporation owns are lessening in value over time as they get used. This even applies to things like buildings and land, right, which are actually things that typically increase in value over time, especially land. And so the idea here is that when these companies go to depreciate, they're declaring a loss. That is an operating loss that they are declaring for maintaining that asset. And what this can do is lower their taxable income. And the reason why this is such a plus is because, again, on their actual books for accounting purposes, they can declare a much smaller loss on that asset. And then when it comes to IRS reporting purposes, they can do what's called accelerated depreciation, where effectively they are declaring a much higher loss. Once again, showing investors and shareholders it's not lying, but almost a different picture of what they're saying they took in an expense for the year versus what they're telling the IRS, which is almost always, hey, we took in less and expensed more, right? And of course, this is so that they can lower their tax burden. So depreciating assets is a popular way of doing that. And lastly, but not least, right, and not totally last, because there are other aspects here that I'm not going to go into because they're a little smaller and they're just very detailed. But in general, tax credits, right, and that's a wide array of ways in which corporations can declare that an investment or an expense towards some sort of action that the government deems as beneficial and wants to encourage that action can therefore be used as a credit towards lowering the actual tax burden of that corporation. And there are a lot of tax credits. If you went and saw all of the tax credits available to different corporations, it's a massive list. And we just expanded that list with the Inflation Reduction Act because of the new tax credits that they're putting in to try and promote green initiatives. So in that way, that portion of the bill kind of is in opposition of what the end goal is, which is to promote more tax revenue. And this is, again, another popular way that companies will lower their burden. And in many cases, like the case of the 55 companies that did not pay, the large companies that did not pay in 2020, after you declare your expenses, after you declare your losses, and depreciate your assets, and after you carry forward your losses from previous years. That's another big one. So in your early years, big corporations are typically losing money, going into debt, trying to fund their operations. And what they can do what they could do prior to this new bill is they could indefinitely carry forward those losses. So if a company makes 10 million one year and 10 million next year, effectively they can claim they've made zero net profits rather than declaring a 10 million loss one year and declaring a $10 million profit and paying actual taxes on that $10 million profit year. So what they would do is just say, hey, no, we had a $10 million loss the year before. We have a net operating loss of zero. We've made no money. And companies are able to do that. And these big corporations, almost all of them, had massive losses in the first years before they really started making gains. So after all of that has been expensed, deducted, and used to lower their tax burden, they can then exercise these credits, which will often turn into not only a net zero tax burden due for that corporation, but that same 55 companies actually received $3.5 billion in rebates in the year 2020. So the government actually paid them to get out of their taxes. So that's all I got for y'all today. If anybody has any questions, yes, there are a lot of other ways and a lot of other loopholes, but those are the main ones. And I hope I clarified some things for you. I know a lot of this is on TV and on the news, and they don't tend to go into very deep detail. So I want to try to do that for y'all. Hope all's well, and talk to you next time.